This is Danny. I'd like to walk you through an investment analysis that I did for a do-it-yourself grid-tied solar install with net metering. I am not a financial advisor or CPA, so I think you probably would need to check my numbers out rather than just accept what I say. I'm not an expert in solar, or I'm not an expert accountant. Um, I don't believe that in my analysis we need to account for a lot of annual maintenance costs, but we do have to have a net metering agreement with the utility to produce our numbers that we need. And this allows us to sell back excess energy that we create. We will sign an agreement with the utility, and then on our monthly bill, we are going to receive credits for energy that we produce during the daytime based on a time of use, which looks about like this. The time of use rates look about like this. So we're going to need to also examine the investment tax credit, which is available for 2018 and 2019. And we're going to need to understand the eligible costs and the ineligible costs of this. So we can fill out next to the cost of the system what is eligible and what is ineligible, so we can come up with the cost of the system net of credit. The other thing we need to do is figure out how much we're going to produce. And the best way I know how to do this is to look at the bill and figure out what were using last year, and then going on to this site right here and figuring out what you're likely to produce based on your roof angle and based on your roof orientation. And I would just start and come up with a certain wattage of a system. So you may start with 385 watt panels, 6 of them for instance, and see what, and with some microinverters, and see what kind of costs that, or what kind of production you end up hitting. So that production is going to end up here, and the rate of that you're going to sell back or that you're going to save would be based on your old bills. And so again, I have estimated that to be about 20 cents per kilowatt hour in this example. Then we're still going to need to kind of take a look at system costs. You may want to look at some grid-tied systems, packages, kits, and that are about the same size as you're looking at. If not, I think it might also be a good idea just to call these guys up at the Alti store. They also have a calculator here that is pretty nice, that could get you roughly what kind of, how big a system you're going to need. So we covered what you're going to produce, how much you're going to pay for it, and let's assume that we're going to have a monthly maintenance cost of $30 for a net savings of $681.40, $680 $681 per year for a number of years. Um, I just did a quick calculation for the payback. That would be 6.25 years. Um, so, but one thing that it doesn't take into account is the inflation of the electricity. Normally, if we were at the end of year one, we would expect to pay more than we did this last year. So I have a correction for inflation here, and if I correct for inflation, I get a different cash flow. The easiest thing for me to do when I look at investment is to calculate the internal rate of return of an investment. That means how much would a similar investment yield me. And so basically this, without the inflation in it, yields 10% over 10 years and 14% over 15 years. But if I correct for the inflation, I get a 13% rate of return on 10 years and a 17 over 15 years. The other thing that I think we need to consider is taxes. Now, it is likely that your tax rate for federal government purposes is going to be probably about 22%. And for state tax purposes, I would estimate that most people will be in the 8%. So we're talking about a 30% tax rate. And in order to pay an electric bill of $100, when you have a 30% tax rate, you're going to have to come up with $142.86. And of course, the energy that we are producing, that we've said that we've wanted to produce, that is not going to be subject to income tax. So if we were to correct for the income tax impact, we would come up with this stream of cash flow, because you see that this is just the basic savings, but then I correct for inflation, and then after that, if I use a factor to correct for the income tax, I get this cash flow here. And with this after-tax cash flow, I get a 22% rate of return over 10 years and a 25% over 15 years. Now, it's important for me to point out that there are a lot of risks. There is event risk. There could be a disaster. The investment is illiquid, so you pretty much have to keep it for 5 to 6 years, or you're likely to lose, your investment. You need to make sure your roof's in good shape, and we could generate leaks during our install. There's a lot of risks associated with the investment. However, I think that the net metering agreement is a very important agreement that it will provide a very positive benefit over time, and we don't know how long those are going to be in place. For instance, Hawaii, their net metering agreement disappeared. So while the projected 22% rate of return is really good, there are risks associated with it, and it's not totally risk-free. I hope this has been helpful, and thank you so much for listening.